Foreign countries are currently experiencing an unprecedented surge in homelessness rates, and this is directly linked to the decline of the American middle class. Recent data indicates that middle-income families are bearing the brunt of the ongoing housing crisis. Please make sure to subscribe to the channel and leave a like below the video. Evictions and foreclosures are reaching alarming levels as affordability problems worsen. Alarmingly, nearly 3 out of 4 middle-class households can no longer afford the current housing prices. This information comes from the National Association of Realtors, which reported that housing affordability in the last quarter plummeted to its lowest point since 1989, standing at just 87.7 points, compared to the historical average of 93.2 points. In 2023, U.S. families are grappling with the highest mortgage payments they've seen since 2000, making homeownership unattainable for almost 90 million Americans, according to Lawrence Young, the chief economist at the National Association of Realtors. Despite falling home prices in many areas, rising mortgage rates are eroding affordability. Consequently, the Federal Reserve is exacerbating the social divide by limiting homeownership opportunities for middle-income renters. This dire situation is compounded by a severe shortage of homes for middle-income buyers, preventing them from accumulating wealth through homeownership. A recent report from the National Association of Realtors reveals that over 75% of homes on the market are now beyond the financial reach of middle-income families. It's a stark decline from just 5 years ago, when 50% of listings were affordable to the middle class. Today, that figure has plummeted to 23%. This data is disheartening but not surprising, given the severity of housing affordability and shortage issues, which could have been alleviated with a more balanced housing supply across different price ranges. Furthermore, the gap widens significantly for low-income workers, with only 11 out of every 100 listed properties falling within their budget. Some companies like Zillow have introduced a 1% down payment option to make property ownership more attainable for low and middle-income Americans. However, with the vast majority of properties still out of reach for average families and low inventory, the effectiveness of such offerings is questionable. Adding to the challenges, 30-year fixed mortgage rates have surged above 7.5%, resulting in significantly higher monthly mortgage payments this year, adding an extra $1,100 to the cost of owning a median-priced home. Redfin's chief economist predicts that rates won't drop below 6% for at least another 6 months, creating a difficult environment for both buyers and sellers. Existing homeowners, many of whom financed their properties during the last decade's ultra-low interest rates, are hesitant to list their homes and face higher payments for a new property, further exacerbating the already strained housing supply. The shortage of homes has led to surprising market distortions in areas where demand far exceeds supply. Middle-class homes are being listed for staggering prices, sometimes reaching $1 million. A study by Redfin found that 8.6% of listed houses in the U.S. had 7-figure price tags in August. Out of the 90 million homes studied by the firm, approximately 7.46 million were valued at over $1 million. A separate report from LendingTree highlighted that in some California cities, there are more million-dollar homes than those priced below that threshold. For instance, in San Jose, 66.28% of homes were over $1 million, followed by San Francisco at 52.91%, Los Angeles at 26.48%, San Diego at 23.15%, and Seattle at 10.70%. These figures underscore how in many parts of the country, million-dollar homes have become the norm rather than a luxury. In numerous regions, million-dollar homes have not only become more prevalent, but have also, for lack of a better term, become more attainable for middle-class individuals. This trend underscores the high cost of housing markets and the types of homes people can expect to encounter in these areas. These homes are not extravagant. They typically have just a few bedrooms and basic amenities. As housing prices continue to rise at a much faster rate than people's incomes, an increasing number of families face the risk of losing their homes. This is occurring amidst a surge in foreclosure filings, driven by factors such as job losses, higher auto loans, student loan repayments, medical debt, and other financial setbacks. In the past year, Hundreds of thousands of homeowners have struggled to make mortgage payments, resulting in property repossessions. In the first half of the current year alone, foreclosure starts increased by 15%, according to real estate data provider Adam's mid-year 2023 U.S. foreclosure market report. Nearly 186,000 properties across the country received foreclosure filings during this period, marking the highest surge in foreclosure numbers. Maryland experienced the most substantial increase, with foreclosure numbers doubling compared to 2022 levels. Oregon saw a 99% increase, Alaska experienced a 95% surge, and West Virginia and Arkansas witnessed rises of 83% and 72%, respectively. When considering notices of default, repossession by banks, and auctions, the U.S. foreclosure market report identified 35,196 American properties with foreclosure filings. Foreclosures are never a positive sign and are reminiscent of the Great Recession in 2008 and 2009, indicating the occurrence of a serious economic downturn. Although the official inflation rate may be tamed, the cost of essentials such as groceries, gas, and rent continues to rise, placing a strain on household budgets. In contrast, Americans' paychecks have not kept pace with these increasing costs. As of September 4th, the national median rent price stood at $2,038, which is quite high considering the national median income is only $54,132 before taxes. In essence, people are spending an average of $24,456 annually on rent. This explains the rising eviction rates across the nation, with Princeton University's eviction lab reporting a 50% increase in eviction filings above the 2019 average. This is particularly troubling for middle-class Americans, as they often do not qualify for government assistance and are expected to bear the brunt of rent hikes. Another alarming trend placing middle-income earners in precarious financial positions and hindering their access to stable housing is the steep rise in medical debt. Middle-class Americans are the most likely to accumulate medical debt, with nearly 1 in 4, or roughly 17 million people, having unpaid medical bills. These households, earning between $50,000 and $100,000 annually, often seek medical care but do not qualify for Medicaid or charity care to help cover the costs. Currently, over 100 million people in the United States are burdened with healthcare debt, which often negatively impacts their credit scores, making it challenging to secure housing. Casey Atentio's story is a prime example. He had difficulty renting an apartment for years due to bad credit, resulting from thousands of dollars in medical debt stemming from a heart attack at the age of 19. Lindsay Vance, a 40-year-old, remains unable to purchase a house due to lingering medical debts. Despite her and her husband's six-figure income, the medical bills they've struggled to pay since her 20s have significantly lowered her credit score, making it challenging to secure a loan. They find themselves in a frustrating holding pattern, unable to build equity through home ownership. Instead, they spend more than 30% of their income on monthly rent, a situation that roughly 50% of renters nationwide have been grappling with in recent months. According to data from Moody's Analytics, the average renter is now considered cost-burdened, allocating 30% of their income toward rent. Alarmingly, about 25% of workers are spending a staggering 50% of their incomes on rent. This troubling trend underscores the fact that many everyday Americans, including teachers, nurses, firefighters, and retail workers, can no longer afford to live in the areas where they work. It's a clear indication of significant issues within the U.S. economy and poses a concerning social situation for the population.